So in this video I'm going to be going over and reviewing a trader's strategy they sent in to me. So I'm sure that a lot of you are going to find value in this, whether you're just getting into trading or whether you're going through a similar thing. So the strategy that this trader is testing is a false break strategy, right? So basically what that means is that he's looking for a false breakout. And just for those of you who don't know, generally what a false breakout is you get a consolidating market, right? So the market is trading in a range, okay, respecting levels, and then the market will break out of this trading range and then reverse, right? So it's a false break. So ultimately he's trying to capture this move down here, right? And without going into too much detail, obviously the anticipation of these levels being respected is that once we break through the resistance, that the market is going to continue higher, right? But obviously this trader wants to take advantage of all the times that the market doesn't continue higher and we actually see a reversal or some sort of relief from this level, right?
So before I start, I just want to say thank you for taking your time to look at my strategy.
Yeah, no, thanks for letting us share it.
And yeah, so let's get started real quick. So the first step I do is find market structure on the higher time frame. I'm trading on the daily time frame.
All right, so just to address a concern that he sent me in a message, right? One of his concerns was that he only got about a 12 trade sample size over about a 10-year period. Now, obviously trading on the daily time frame, if you look at this range here, okay, so from where my cursor is, this is 2005 to 2009, right? So that's about a 5-year period. Now obviously if we go over to the hourly, if I scrunch my chart up and we just look at how many bars are here, right, there's probably about the same amount of bars as on this screen here, okay? But obviously this is a 5-year period or a 4-year period, right? And this is the space of about 2 weeks. So, you know, the sample size that you're getting is obviously, it sounds pretty normal for the time frame that you're trading on. Obviously the lower down on the time frames you go, the more opportunities you're going to get. See, the way that you can consider increasing your frequency of trades when you're trading a higher time frame is to increase the amount of pairs that you can trade it on, or the amount of pairs that you test and sort of verify your strategy on, and then you build out a portfolio. So all of my strategies that I trade on the daily, I built out a portfolio of 28 pairs that I could trade. Now, obviously, some people you see that only trade, they only trade 1 or 2 pairs. Maybe they trade, up to 6 pairs day trading. But that is because that they have got the frequency, because they've got a high frequency of trades because they're on a lower time frame, right? So obviously, it might seem overwhelming if you've got 28 pairs, but obviously, you just bear in mind that the markets are going to move a lot slower, right? So you're going to have time to go through your setups, right? Because obviously every time a candle prints, if you're trading on the daily time frame, is 1 day. So whatever time the market closes for you, wherever you are in the world, let's say it's Eastern Standard Time, right? You just clock in at 5 o'clock, okay, or whatever time that you can consistently approach the charts, and you just go through your 28 pairs. And obviously that candle is going to take a whole day to print before you've got to check it again. And as you can probably appreciate, if you're trading a false breakout strategy, right, then you've got quite a lot of time between setups. So let's say that the market is doing something like this, right, and we've got our consolidation and we're trading around about here. Obviously, we know that we're most likely not going to get a break on this pair, okay? So we can put that pair to the side. And obviously, we can narrow down our watch list, right? So obviously, when the market gets to sort of this level, right, and it starts to approach down here, which bearing in mind is going to be a few days, maybe even a few weeks, then you can put it on your watch list and think, right, okay, now I need to watch this pair just in case I get a false break, right? And alternatively, another thing that you can do, right, just to bear in mind, is you can add strategies to your portfolio. So obviously, you might have only got 10 trades over, let's say, a 10-year period on 1 pair, but if you incorporate all 28 pairs, all of a sudden that's 280 trades. Right, now you add 3 more strategies, right, with a similar sort of strike rate. Now you've got 1,000 trades. Okay, so that's how you can start to increase your frequency when you're trading on them higher time frames, right? But one thing that I'd bear in mind when you're doing that is just be careful of correlation risk, okay? Because obviously some of the markets are going to be correlated, so that's something you're going to have to build into your trading plan. So
I check out the higher time frame. So it seems like it's in a range.
Right, okay. So this may seem like you don't need to do it, but you do. Obviously, your higher time frame, you need to define whatever that is, whether it's your monthly or your weekly. You need to define your higher time frame. You need to define your trading time frame in your plan. Okay. Second of all, when you use words like "it seems like it's in a range," that really needs to that needs to be solidified, right? Because as you go through testing more pairs and you keep, you're sort of going through the market, I can assure you, right, because it's happened to me, and I know this through first-hand experience, that as you start to go through the market, you start to look at more trade setups, gradually what you consider to be in a range, right, seems to be in a range, will gradually change ever so slightly over time. Okay, so your backtesting results are then going to be inconsistent. If you don't solidify them rules, then going into your live trading is going to be inconsistent, right? So what you really need to do, you need to eliminate any of the subjectivity. So it seems like it's in a range. You need to have solidified rules in your plan that tells you this is in a range. Okay, so what I mean by that is maybe something like this, okay, where we have got a rule that says if the market puts in a swing low and a swing high, then I draw on my horizontal lines at the extremes of them levels, okay? And obviously note how I'm saying these rules. They're said in an if-then syntax, right? So you go through like a set of instructions. So if the market puts in swing highs and swing lows, then I draw on my horizontal lines at them extremes, right? If the market respects the bottom line and the top line again, so altogether I've got 4 tests, then this is considered a trading range. Okay, so note how now we've defined a trading range. Okay, so we've got definitive rules that tell us what a trading range is, so that when we go through we can be consistent. So a good thing to remember is consistent analysis, consistent execution, consistent results.
Alright, so since I know it's in a range, I draw my areas of value, support and resistance.
Okay, so where do you draw your areas of value, right? Why not here? Why not here? Why not here? Okay, that needs to be defined.
Now this is what I look for here. Second, it's in a range. The third step must be a clean move into area of value. So when I say that, this move right here, clean move where there's mostly bullish candles, look for that clean move. But I also look for this here. Let's make sure price takes out previous high as it did here. So when it does that, I look for a setup.
Okay. One thing you may want to add here, right? Just something to consider. When price is in a trading range like this, okay, these moves are generally going to move like this, right? The market is going to ebb and flow up to your level, right? So what you can look at when you get a break of this level is to look at whether you get RSI divergence. And what I mean by that is obviously your price action is going to be putting in higher highs, right? And then you want to look to see if your RSI is putting in lower highs, okay? and that is generally a good indication that price is likely to reverse, right? Obviously in conjunction with other filters, okay? So like your support and resistance, like your fake breakouts and that kind of stuff, right? Your rejection price patterns. And alternatively, another thing that I'd consider looking at is only to look at that if price pushes up to your horizontal line and then breaks above. Right, it's just something to consider. It's just something to keep an eye on, to look at, see if it makes a difference. But obviously, you're going to have to don't just sort of take my word for that. You're going to have to sort of track this and write it down, because obviously you need to know whether it's worth changing, right?
So I wait for a price rejection. Price rejection down here for an entry trigger. So let's go forward. Still not strong enough. Still wouldn't call that a strong enough price rejection, but
okay. So right, I know again this sounds sort of a bit repetitive, but you need to define a strong price rejection, because obviously you're thinking then. Now, don't get me wrong, right? There's going to be a level of intuition that comes into play here, but you need to write it down, because as you need to have rules around it, right? Because as, like I say, you progress through your trading and you build your reticular activating system, and your eyes change, which they will, as you're going through your testing and you're developing as a trader. A strong price reaction is going to change for you, right? And not only that, it's going to change depending on how you're feeling on the day, and how your trading's been going as well, right? So let's say, for example, that you have been, you've been losing a lot of trades, right? And then you get a price rejection. You may feel like, yeah, that's not strong enough, right? And you may miss a winning trade, right? Or alternatively, you may have been winning a lot of trades, and then you might see a price rejection that maybe you might necessarily not usually take, but you're on a winning streak, you're feeling quite confident, right? And you take a trade that you shouldn't be in and you lose. Okay, so you really need to define, your plan is there to tell you when and when not to get out of the market, right? Which obviously, it needs to be non-subjective, non-arguable, non-negotiable rules, right? Like using words like seems and when you're sort of thinking, that is very subjective. So you want to try and eliminate that as much as possible, altogether, right?
if I'm not sure, I take out the average true range. So let's multiply 682 times 1.5, 1,023. I'm pretty sure it's not. No, price rejection is not strong enough. So let's go forward. Still not a strong enough price rejection, so let's keep going forward. And there you go. This is my entry trigger to enter the trade, 1,090 pips. It meets my criteria, so I enter the trade. If I was to trade this now, I'll enter on this candlestick. Okay, so where I put my stop loss is before opposing pressure, so it will probably be right here where this bullish candle is. For my stop loss, 1.5 ATR, 1,068. So 1.5 ATR above highs is somewhere around there. However, there's times, but yeah, this previous high here is going to be a problem. But that's what I usually do. Sometimes I use 1 ATR. The stop loss won't be too big. Be 700 pips. It'll usually be around here. And that's how I will enter my trade.
Alright, so if we just go back to where this is on the chart, so where is this? January 30, 2009, right? Alright, so this looks round about where you got into the trade, yeah. So that's about where you got into the trade. So one thing I'd suggest, right, when you're looking at stops and targets, I would consider, as you can see, look, the market sort of rolls off there, right? I'd consider when you're looking at target taking, okay, to track multiple different targets as well. I have found personally that that can make the biggest difference in terms of profitability of a system. Okay, so let's say that you look at something like this, right? You got something like this. You get your false breakout. Okay, so I'd test a test of the trading range, right? Another test of the bottom of the trading range or the top, whatever way around we're looking at it. Okay, stops 1.5 ATR below the low, right? And then what you often find is that the market can continue higher, right, and just continue going up like this. Okay, then as the market continues higher, obviously it hits your target one, you roll your stops to break even, pulls back, and we get an extension. When we break and close above this, high, consider or test rolling your stop to, I don't know, 1 ATR below this outside return, right? This being your outside return. And obviously when the market, then we get a pullback, okay, and an extension higher, and we break and close above this high, right? Look to move in or roll in your stop loss 1 ATR below this outside return, right? And obviously, it continues as we're sort of moving higher, okay? So your stop loss gets higher, and you lock in profit as you go, right? So you don't cap your trade, because technically this could just continue. You don't want to necessarily be coming out of trades if they're going to run, right? You want to let your winners, you want to cut your losses short and let your winners run. I'm sure that you've probably heard that saying around, right? And obviously, from the testing that I've done, definitely is a good way to increase the profitability of a system. So that is something I'd consider with target taking. Obviously, you can look at the alternative stop loss levels as well. So obviously, you're doing a 1 ATR below your rejection. You can do it just a few pips below your rejection, right? So obviously, you're going to have, let's bring on this tool, right? So let's say that this is your initial position, right? And this is 1 ATR or 1.5 ATR. Obviously, that's quite a nice, you're giving your trade a lot of breathing room. Again, this is probably going to be down to personal preference as well, but alternatively, you can look at having a tighter stop, which is going to increase your risk reward profile, right? So obviously you can see here, this is about a 3.7 to 1, and a 1 ATR may be just about a 1 to 1, 1.5 to 1. So I'd consider testing that as well. What difference that makes. Obviously, there's going to be pros and cons to each, because in situations where you're giving your stop a bit of breathing room, obviously, the market, you've got more chance that the market's going to go in your favour. With a tighter stop loss, obviously, you've got a higher risk reward, but then you run the risk of being stopped out, right, before you get that move higher. So just a few things to consider there. Right, so another thing I'd say as well, right, I'd definitely look at your false breaks, because to me, this isn't a break, right? To me, that has respected that level. So if we just pull it over here, right, so around here, I believe, is where you would have entered the trade. Now, to me, right, that level has been respected, right? And obviously, if you look at what I was saying about the RSI divergence, we do actually get divergence on the RSI, okay? So if you look at these highs and these highs, right, we get divergence on the RSI, then we get a rollover. To me, what a false break is a trading range, right? So price in a trading range, like, let's see if we can find an example. If this, I thought it broke, it doesn't actually break, but obviously if this was to break and close above and then push down, but obviously, you don't have to do that. You can look at different things. Obviously, this is sort of a similar setup to what you was looking at. Maybe you sort of identify it differently. So again, it's similar sort of thing to what you was looking at, to be fair. Look, you break this level, we get a strong push into this zone, right? And we also do then get divergence on the RSI, okay? And then we see a rollover off from that level, right? So, just something to consider. I'd really, look at solidifying your rules about trading ranges, what you consider a false break to be. Because to me, that is really, I suppose it is a false break of this level, but you're still respecting that trading range. But just make sure that you know what you're looking for, what you're looking at, right? There's no sort of right or wrong to it, as long as you know what you're identifying, okay? Again, you need to make sure that you know what you're identifying, because as you go through and you develop as a trader, I can assure you, your eyes will change and you want to keep that consistency. And you also want to know how you tested stuff, so that when you go back and you optimize, you know how you approached it, right? So that you know that what you're changing, if you decide to change anything, is actually worth doing. You can crunch the numbers and know that, right, I've tested it this way. Now I'm going to go through and test it this way. You can compare the two, which is better, right?
So I managed to put one ATR stop loss above highs, took profit on lows, and that's how I do my trades. Or at least for the false break. Just let me know if this is even a strategy at all. I only managed to get a couple trades off of GPB and ZD. And yeah, there's other type of strategies I have in mind, but I'm not sure if I should keep moving forward with this one. So please let me know if anything, man. And thanks once again.
So obviously, I know you. Okay, so again, obviously, we discussed about your trade sample size at the beginning, right? So one thing that I do want to clear up: anything is a strategy, right? Just because it's not, you haven't sort of pulled it off of Google, and it's not a typical strategy, right? That people trade. Sometimes they are the best ones, right? That you sort of develop yourself. Anything can be a strategy, right? And this is something that I think a lot of people struggle with. To me, a definition of a trading strategy, right, is a set of specific rules, okay, that are non-arguable, non-negotiable, that you have tested and you've verified. And if it comes out profitable, right, obviously that is your strategy, right? It can be anything. Anything can be a strategy, okay? So don't get too caught up in, that it has to be a certain way, right? That you can have anything as a strategy, right? You could literally look at the charts and say, right, if I get three down candles in a row, then I sell, right? So let's say, look, we're looking at here, look, 1, 2, 3 down candles in a row. I sell at market, put my stops above the high of that candle, and then I look for targets at the most recent level of previous structure. Right, that can be a strategy. I've literally just made it up. Same with like 3 upwards candles, right? So I get 3 bullish candles, okay, I buy at market. I put my target at previous structure, right? So this one would be, obviously we'd be out the trade there. And then look, 1, 2, 3, okay, so buy at market, right? Stops below the low of the previous candle. Targets at the most recent level of outside structure, right? Obviously that one then is a loser, okay? But then this one, look, 1, 2, 3 bearish candles, right? Stops sell at market, right? Stops just above the high of the previous candle. Targets at the most recent level of outside structure. That one won, okay? 1, 2, 3, same there. Look, so we've got another sell there, right? Sell at market. That would be an inverse risk reward, so we wouldn't take that trade, right? Obviously, build another rule. If the trade is an inverse risk reward, then we don't take. But basically what I'm getting at is that you can have anything as a trading strategy as long as you've got specific rules for it. You go through, you get a big enough sample size, you test it consistently, and you get a positive expectancy out of that system, right? So thanks for obviously letting me share it. I think you should carry on moving forward with it, definitely. I think there's definitely, you got something there. I think you need to solidify your rules a little bit. You need to look, because where I think you Yeah, so look, you've sort of written your rules out there. Like, that is nowhere near sufficient, right? And I'm just being sort of, I want to help you, right? So I'm just sort of being brutally honest. That obviously, as the trader that's done it, sort of what you've sort of done, but honestly, you really, really need to sort of change them to if-then syntaxes, right? So basically, like a board game set of instructions, they need to be a lot more specific. You need to know exactly what you're looking for. Eliminate all the subjectivity. Carry on testing. Get a bigger sample size, right? Go back even further. Go back to as far as you can. I'm pretty sure if you go to the daily time frame, right, on daily time frame on pound New Zealand on TradingView, go all the way back. Look, yeah, 2002 you can go back to, right? So go all the way back to 2002, test that, go through all 28 pairs, right? Test all 28 pairs. Start building out a bigger portfolio, right? And test other stuff, as in like test different target placements, right? See whether you can improve it by taking targets at different levels, stops at different levels. Also look at trailing stops so that you don't cap your profiting potential, right? And then obviously make a judgment off of that, and then obviously you can look to incorporate other strategies into your portfolio to then build up that frequency, right? So the only thing that I'd be concerned about personally is the sample size that you got. So obviously the trouble is when you're on them higher time frames, like the daily, weekly time frame, that is a downside to it. Obviously you're sometimes, depending on your strategy, you're limited to the sample size, right? So ideally what you want to be aiming for is 100 trades. That's what 100 trades per strategy per time frame, okay, per pair, right? So obviously on the daily time frame you're restricted, so you're going to have to go back as far as you can and just get what you can, right? And then look to build out your portfolio, so test as many pairs as you can and make a judgment on the whole portfolio, right? Because then obviously you're sort of getting your sample size through other pairs, which isn't ideal because some of them are going to be correlated slightly, but it's going to give you a better idea than just looking at one pair, whether or not to pursue it, right? And what I say whether or not to pursue it, I think you should pursue it. I think you should carry on going with it personally, but continuing testing it and trying to make it work is different from actually going out and live trading it. Obviously, you need to put in a lot more work with this. You need to solidify them rules. You need to get a much bigger sample size, but obviously it'd be interesting to see the results you got as well. So if you have got the results to hand, ping them over to me. It'd be interesting to sort of look through your backtesting results, see what you tracked, see how them results came back. Obviously it doesn't matter how that turned out, right? Whether it was profitable or not profitable, that's the idea of the testing, right? To find this out. So obviously just be sure that when you go back and you try and get your sample size, not to sort of force trades, right? You want to be honest with yourself about this, right? Because your backtesting is so important for your live trading psychology. There's no point sort of taking trades that you wouldn't, like in your backtesting, that you're not going to necessarily take, that you're not going to take in your live trading, and you're just going to sabotage yourself. There's no point doing that. So as I say, my only concern is the sample size, but I think that also comes with not only the time frame, because you can get a big sample size on some strategies on the daily time frame, but as well it comes from the nature of the strategy as well, because obviously you're looking for a false breakout, so some of the times the market's you've got quite a lot that needs to happen before you're looking for your move, which isn't necessarily a bad thing. And just don't forget that this is only one strategy in your portfolio that you can build out. Obviously, like you say, you've got your eye on other strategies that you can look at. So yeah, but going back to the sample size, obviously with your backtesting results, I wouldn't get too discouraged if it didn't come back very well, because you can have 10 trade losing streaks, right? Like if you was to get 100 trade sample size, the probability that you are going to get 10 losers in a row is relatively high, depending on your win rate, right? So yeah, that is the only sort of grey area I've got about this, is the fact that your sample size, I personally wouldn't feel too comfortable with that. But obviously everybody's different. I can't tell you, you know, it's ultimately it's down to you whether you're happy with it, whether you're comfortable with it. The way to sort of combat that, like I said, is just to test as much as you can, go back as far as you can, test as many pairs as you can, and make a judgment from your whole portfolio, right? So, right, so I hope you got value from that. I hope that helps. If it doesn't, or you got any other questions, just drop me a message, because whatever questions you've got, I'm sure there's other people that are asking the same questions, right? So if you got value from the video, make sure you leave a like. If you didn't get value from it, hit the dislike. Let me know why, and obviously I can try and address that, right? And wherever you are on your trading journey, I hope you have a good week, and I'll see you on the next one.